silver just became a critical mineral in the United States. And if that sentence sounds like paperwork to you, that is exactly the point. The biggest moves in commodity power often look boring at the moment they happen, then obvious when it is too late to pretend you did not see them. Until this update, silver lived in the public imagination as a trade, a hedge, a speculation, a shiny proxy for fear. But a government does not make a list like this for your portfolio. A government makes a list like this because it is trying to prevent a future where a factory line stalls, a defense supply chain breaks, or a strategic industry gets held hostage by a disruption it cannot absorb. By the end of this episode, you will know what it actually means when a metal gets labeled critical, what changes and what does not, and how to spot the real signal before the chart starts telling a story that feels like it came out of nowhere. If you value this kind of calm, forensic breakdown, subscribe. This channel is built for long-form investigations, not slogans. And if you know someone who thinks silver only moves because of memes or manipulation, share this with a friend. It will help them see the mechanism. Now let us begin where power actually begins, in a place most investors never visit. A page that looks like it was designed to put you to sleep. The Federal Register. DINSI, ticks, formal language, definitions that seem lifeless until you realize that this is where reality gets coded into procedures, and procedures become the rails that markets ride on. In early November of 2025, the Department of the Interior, through the United States Geological Survey, published the final list of critical minerals for that update cycle. The list is meant to be revisited. Mineral criticality changes over time as supply chains change, demand changes, and geopolitical pressure shifts. Here is the part that matters. The final list expanded. It kept every mineral from the prior list and added more. The total became 60. Silver is one of the additions. If you are hearing that and thinking, fine, a list, who cares? You are reacting like most people react to the first page of a big story. The list itself does not pull silver out of the ground. The list itself does not build a refinery. The list itself does not push a bar into a warehouse. But it changes something far more important than the daily tape. It changes attention, because inside government, attention is not a feeling. Attention is budgets. Attention is staffing. Attention is approvals. Attention is procurement. Attention is which projects get fast-tracked, which ones get funded, which ones get meetings, and which ones get ignored. In commodities, ignored is where bottlenecks live until they become emergencies. So the real question is not, did silver get added? The real question is why, and what the addition allows the system to do next. To answer that, you need to understand what a critical mineral designation is trying to measure. A critical mineral is not defined by beauty. It is defined by consequence and vulnerability. Consequence means the mineral matters to the economy and national security. If it disappears, the damage is not just inconvenience. It is measurable loss. Vulnerability means the supply chain is exposed. That exposure can come from import dependence, concentration of production, limited processing capacity, single points of failure, or political risk that cannot be hedged with a simple contract. Put those together and you get the logic of the list. This is not a popularity contest. It is a disruption test. If the supply breaks, how hard does the country get hit? And how likely is the break? This is why the list can change even when the metal itself did not change. What changed is the world around it. How much the country relies on certain inputs, how concentrated certain steps of processing are, how fragile logistics became under stress, how quickly a modern economy turns a missing part into a cascading failure. So why would silver qualify under that lens? Because silver is not only a store of value story, silver is an electricity story. Silver shows up in the quiet places where modern systems need reliable conduction, and reliability is non-negotiable. It is embedded in electronics. It is embedded in connectors and contacts. It is embedded in industrial components that keep machines switching, sensing, and communicating. It sits inside power systems where failure is not an option. And it threads through supply chains where substitution is not always easy because redesign is slow and certification is expensive. This is not a poetic claim. It is a practical claim. If you remove silver from a system, the question is not whether a spreadsheet can replace it. The question is whether engineers can replace it quickly without breaking performance, safety, and standards. That is one side of the equation. Consequence. The other side is vulnerability. Silver supply is not a simple faucet you can open wider on demand. A large share of silver supply comes as a byproduct of mining other metals. That means even if silver demand rises, you cannot instantly scale primary silver output the way you might imagine. The supply response is constrained by decisions made in other commodity markets. If silver rides on the back of copper, lead, zinc, and gold production, then the silver pipeline depends on cycles that are not controlled by silver demand alone. That is a hidden fragility, not because silver is rare, but because silver supply is not fully self-directed. Now add the processing layer. A country can have mineral potential and still be vulnerable if it cannot process enough material domestically, or if it depends on a concentrated set of foreign processing channels. In a disruption, the problem is not that metal exists somewhere on Earth. The problem is that it is not available to you in the form you need, on the timeline you need, through a channel you trust. If you want a single sentence that captures the entire logic of critical minerals, it is this. Existence is not the same as availability. Availability is permission, processing, logistics, and timing. So when silver is added to a critical minerals list, the message is not that silver is rare. The message is that silver is strategically inconvenient to lose. And that is a different kind of value. Now, be careful here. This designation does not mean the government will start confiscating silver or banning private ownership or locking the doors on your local dealer. Those are dramatic stories that thrive online because they feel like a movie. The real world is usually quieter and more powerful. What the designation does is open doors. It can make projects more competitive for certain forms of government support. It can strengthen the case for permitting urgency, especially for projects that address supply chain resilience. It can change how agencies prioritize research, mapping, processing capacity, and domestic manufacturing links. It can influence how large buyers think about long-term supply because government signal changes corporate planning. When a metal becomes part of a national resilience conversation, procurement teams start treating it differently. They start asking how much they can secure, not how cheaply they can gamble on spot. That is where the market begins to shift, not on a chart, but in contracts. And this is where you should zoom out and see the hidden ledger that most people miss. You might think you are trading silver, but the real payment is often made in time and certainty. You save a little on price when you treat silver like a simple macro trade. But you pay later when the system starts charging for immediacy is deliverable metal now, not later, in the right form, from a reliable channel. In a loose market, immediacy is cheap. In a tight market, immediacy becomes a premium. And when policy attention shifts, the first place it tends to show up is in that premium, because big buyers do not wait to be surprised. Now, let us make this tangible. Imagine an industrial buyer that cannot afford a delayed shipment. They do not care that futures printed a calm candle this morning. They care that their supplier can deliver on schedule for the next quarter and the next year. When the policy world starts talking about vulnerability, that buyer becomes more conservative. More conservative means more inventory. More inventory means pulling demand forward. Pulling demand forward tightens the near-term market, even if the long-term supply picture looks fine. That is how quiet policy attention becomes physical tightness. And you can see it without reading a single government document, if you know where to look. You see it when premiums stop behaving like a temporary fever and start behaving like rent. You see it when lead times stretch and do not snap back quickly. You see it when the market starts talking about allocation, not because the headline says shortage, but because sellers are managing limited immediate supply. You see it when regional price differences persist longer than they should, because arbitrage is not clearing the friction easily. This is why the episode is going to do two things. It is going to show you which levers are real after a designation like this, and which ones are mostly symbolic. And it is going to show you how to watch the price of immediacy, so you can tell whether this change is becoming a real supply chain event or just a headline that fades. Because there is a difference between a label and a force. A label is a word on a page. A force changes behavior, and the moment silver becomes critical in policy terms, behavior starts changing in places you do not see until you do. Now think about why this happened now and not years ago. The global economy is moving deeper into electrification, grid expansion, and high-density computing. The world is demanding more reliable conduction, more connection points, more switching, more power management, more sensors, more components that live inside devices you never think about until they fail. At the same time, the geopolitical environment has trained governments to fear concentrated supply chains. Not because governments suddenly discovered economics, but because recent disruptions made the cost of dependence undeniable. That is the environment in which a list update becomes meaningful. It is the environment where a metal that used to be treated like a financial curiosity can be reclassified as a strategic input. And once that happens, the key question becomes simple. Where does the system bottleneck when everyone cares at once? Because if you want to understand what comes next, you do not start with the mine. You start with the choke. You start with refining and processing. You start with fabrication. You start with the points where a small amount of disruption creates a large amount of delay. That is where the premium is born. That is where the market begins to behave as if silver is scarce even when silver exists. And that is where the real story starts. Because the moment a bottleneck becomes visible, the country does not respond with a tweet. It responds with tools. And tools are not all the same. Some tools push supply, that is permitting support, faster reviews, a clearer path through paperwork that normally takes years. It is mapping and geological work that makes projects bankable. It is support for processing and refining, so a miner does not have to travel through a foreign choke point before it becomes usable metal. Some tools pooled demand. That is procurement. That is long-term offtake agreements. That is strategic purchasing that turns a market into a planned supply chain. When a large buyer signs an offtake, it is not buying a chart. It is buying certainty. And when enough certainty gets purchased, the floating pool of available metal shrinks. Some tools change incentives. That is eligibility. That is the subtle difference between a project being considered normal and a project being considered strategic. In a world of limited attention and limited capital, that difference decides which checks get written. This is why you cannot treat the designation as decoration. It is a switch that allows action, even if the action is not immediate. Now let us address a couple of myths that will sabotage your understanding if you let them live in your head. The myth is that critical means rare. It does not. Critical means the country cannot easily tolerate disruption. Another myth is that critical means the price must surge immediately. It does not. Markets can ignore structural shifts for a while. Sometimes they ignore them until the moment they collide with a stress event. That collision is when people suddenly act as if they always knew. That is why this update matters, even if you do not see fireworks tomorrow morning. It changes the background, physics. It puts silver in the same category as materials. The government openly worries about materials where the question is not, do we like the price, but do we have the supply chain? And the supply chain question leads to a specific kind of behavior. It leads to preparation. Preparation is paperwork, contracts, and capacity. It is not loud. It is not exciting. It is the slow tightening of optionality is the ability to source from many places on short notice without paying a penalty. When optionality shrinks, the market becomes sensitive. When the market becomes sensitive, small shocks create big moves. So if you want to understand what this designation could do to silver, stop thinking in terms of a single headline catalyst and start thinking in terms of a supply chain being repriced for resilience. Resilience has a cost. Sometimes that cost is paid in subsidies and grants. Sometimes that cost is paid in higher premiums for immediate delivery. Sometimes that cost is paid in inventory being built where it did not exist before. And sometimes that cost is paid in the quiet transfer of bargaining power from buyers to sellers who control the choke. Now, there is one more detail about the way this update happened that matters for how you should read it. This did not appear out of thin air overnight. A draft list and an updated methodology were put out earlier, with a window for public comment, and then the final list was published after that process. That matters because it means this was debated, measured, and formalized. It was not a casual press line. It was a decision that had to survive scrutiny. So when you hear silver described as critical, you should not hear hype. You should hear that someone ran a scenario in their head and decided that a supply disruption would be costly enough to matter. Now we come to the point where the episode becomes practical. If silver is now a policy metal, what happens to you? You might be a retail buyer thinking about coins and bars. You might be an investor thinking about miners and exposure. You might be a viewer who simply wants to understand why the market keeps feeling tight even when the chart looks calm. The answer is the same. You watch the choke point. Because policy attention rarely hits the mind first. Minds are slow. Policy attention hits the bottleneck first, because bottlenecks are where resilience can be bought. If a country wants more secure silver, it can encourage domestic processing, it can encourage fabrication, it can encourage recycling, it can encourage long-term sourcing relationships. Those moves do not create a magic shortage, but they can tighten the free float, the portion of metal that used to be available without long-term commitments. That is where the price of immediacy changes. So the story we are building is simple. Silver was added to a critical minerals list. The label itself is not the event. The label is the permission slip for a sequence of actions. And the sequence begins where systems always begin when they feel vulnerable. At the choke point is where resilience is purchased and where a market quietly changes its behavior before anyone calls it a new era. For silver, the choke point is rarely the mine. Mines are slow. Mines are capital intensive. Mines are political. Mines are geology. You cannot wish a mine into existence on a quarterly schedule. The choke point is the part of the chain where metal turns into something usable, where supply is transformed from or in concentrate into refined material, then into fabricated forms that industry can actually use. It is the step where capacity matters, where quality standards matter, where logistics matter, and where a disruption can freeze a whole downstream system even if the upstream metal exists somewhere else. That is why the critical designation matters. It does not change the atom, it changes the planning. When planning changes, behavior changes, and when behavior changes, price changes. Not always in the way people expect, because silver is not one market. Silver is a stack of markets that trade on different clocks. The investment clock is fast, it reacts to fear, rates, and narrative. It can swing the headline price in minutes. The industrial clock is slow, it reacts to contracts, lead times, compliance, and delivery certainty. It moves through procurement cycles. The policy clock is slower still, but when it moves, it changes the rails that both clocks run on. A critical designation is a policy clock move. It tells the system, this is a supply chain we care about, not only as a trade, but as a vulnerability. Now, you might be wondering what a government actually does after it tells itself it cares. It does not wave a wand. It does not magically add ounces. It does not rewrite global supply overnight. It does what institutions always do when they feel exposed. It builds redundancy. Redundancy in commodities is not a philosophy. It is infrastructure, contracts, and capacity. It is a second source. It is a domestic step where there was none. It is a stock buffer where the buffer used to be thin. It is a plan for processing and recycling, so a single foreign choke point does not decide whether your factory runs. And the way that redundancy gets built is through a handful of quiet levers. Some levers are about money, eligibility, grants, loans, partnerships, incentives that make certain projects more financeable than they were before. Some levers are about speed, faster reviews, clearer permitting priorities, coordination across agencies that can reduce the time a project spends wandering in bureaucratic fog. Some levers are about procurement, long-term contracts, offtake agreements, and strategic purchasing behavior that turns a spot market input into a planned supply chain input. Some levers are about knowledge, mapping, surveys, data, and research that reduce uncertainty and make domestic development more realistic. You do not have to believe every lever will be pulled. You do not have to assume a dramatic intervention. You only have to understand that once a metal is classified as critical, the probability of action increases. And in commodities, probability changes behavior. Now, here is the subtle but crucial point. Even if the government never buys a single ounce directly, the signal alone can change private sector planning. If you are a manufacturer, a critical designation tells you that policymakers believe the supply chain has vulnerability. That nudges your risk assessment. It encourages you to secure supply earlier, sign longer contracts, carry more inventory, and pay for certainty. If you are a producer or a processor, the designation tells you your sector may receive more institutional attention. That can change financing conversations. It can change which projects get meetings. It can change the confidence of capital. If you are a trader or an intermediary, the designation tells you the environment is shifting toward resilience over pure efficiency. Efficiency is the world of lean inventories and just-in-time delivery. Resilience is the world of buffers. Buffers tighten the floating pool of metal. That floating pool is what makes spot markets feel liquid. When the floating pool shrinks, the market becomes more sensitive. This is the part most people miss. A market can feel tight without total supply collapsing simply because more of the supply is spoken for in contracts and buffers. You do not need a shortage of metal. You need a shortage of free metal. Free metal is the metal that used to be available without permission, without long commitments, without paying a premium for immediate. When a system shifts toward resilience, it tends to buy down uncertainty by reducing the amount of free metal in circulation. Now, that does not mean prices must surge instantly. It means the shape of risk changes. The risk becomes more episodic, more sudden tightness windows, more periods where premiums jump and do not instantly normalize, more dislocations between what the paper price suggests and what the physical market feels like. If you have been around silver long enough, you have already seen a version of this. Times when the chart says one thing, but the real cost to acquire certain forms of silver says another. That divergence is not magic. It is a signal that the market you are looking at is not the same market someone else is operating in. So let us be precise about what you should watch, because this is where the episode stops being interesting and becomes useful. If the critical designation is becoming a force rather than a label, it will show up first in the price of immediate. You will see it in persistent physical premiums that do not fade after the headline cycle moves on. You will see it in lead times that stretch and do not snap back. You will see it in tighter terms, allocation language, and minimum order requirements that creep upward. You will see it in persistent regional dislocations that do not close as quickly as they used to, because arbitrage is not cleaning the market smoothly. You will also see it in how companies talk, not in public hype language, but in procurement language, words like secure supply, long-term agreement, diversification, juris, resilience. Those words are boring, but they are the real beginning of a demand pull forward. Now, let us talk about winners and losers, because every policy shift creates them, even when no one announces them. The first winners are the choke point owners, the refiners, the fabricators, the processors, the parts of the chain that can say yes when someone needs a delivery now. When a market shifts toward resilience, those nodes gain bargaining power. Bargaining power becomes margin. Margin becomes investment. Investment becomes more capacity. More capacity becomes more influence. That is how supply chains reorganize around the places that can deliver. The second winners are credible domestic projects with realistic timelines, not fantasies. Not slogans. Projects that can actually move from plan to production without endless friction. The third winners are any firms that already have relationships and contracts with industrial buyers, because resilience is built through relationships. In a stressed market, trust becomes a premium. The losers are the participants who live on thin buffers and short time horizons. Manufacturers that rely on just-in-time delivery and do not want to carry inventory. Small buyers without long-term contracts. Participants who assume spot liquidity will always be there when they need it. In resilience regimes, the market becomes less forgiving. It rewards planning and punishes last-minute sourcing. Now, you might be thinking, that sounds like a long, slow story. Why would the chart care? Because silver is not only a physical commodity, silver is also a financial mirror. When people sense structural change, They try to front run it. They buy the story before the supply chain shows it. Sometimes they are right. Sometimes they overshoot. But even overshoots matter because overshoots attract leverage. Leverage attracts volatility, and volatility turns silver into the kind of market that can move fast enough to surprise people who thought they had time. This is why you should not confuse this episode with a simple bullish pitch or bearish pitch. This is not about direction. This is about regime. A regime shift changes what kind of market silver is. In a normal regime, silver trades like a macro instrument, reacting to rates, currency, risk appetite, and sentiment. In a resilience regime, silver begins trading more like a strategic input, where procurement behavior and supply chain constraints add a floor of industrial urgency in certain windows. You can still get drawdowns. You can still get brutal sell-offs. Silver is silver. It will always be violent. But when the underlying system is tightening optionality, the rebounds become more aggressive and the tightness episodes become harder to dismiss. Now, because we are staying honest, we must build the strongest counter case. The counter case says a list is a list. It is a label. Labels do not build minds. Permitting is slow. Processing projects take time. Political cycles change priorities. Bureaucracy can be loud and slow and ineffective. Industrial substitution and thrifting exist. Recycling can expand. Demand can soften if the economy slows. And silver, for all its importance, is still a market where sentiment can dominate for long stretches. That counter case is real, so the only responsible position is this. Do not assume the designation guarantees a supply chain transformation. Assume it increases the probability of follow-through, and then watch for evidence of follow-through. Evidence of follow-through is not one speech. It is repeated footprints. More project announcements that survive beyond headlines. More capacity plans that move into construction. More procurement signals that show buyers securing supply. More consistent physical tightness signals. If those footprints do not appear, the designation remains a label, and the market returns to being mostly macro-driven with occasional bursts of tightness. If those footprints do appear, the designation becomes the first page of a longer story, where silver earns a strategic premium not because it is rare, but because it is hard to replace quickly where it matters. Now, I want you to feel the difference between the two outcomes in your gut, because this is what changes how you behave. In the label outcome, silver remains primarily a sentiment market. It rallies on fear. It drops on rates. It ipsaus. It frustrates. In the force outcome, silver becomes a market where physical episodes matter more, where the cost of immediacy becomes a recurring theme, where the supply chain gets tighter even when the chart is quiet, where volatility is not just emotional, but structural. In both outcomes, you still need discipline. But in the force outcome, you also need to pay attention to physical signals, because the market can reprice faster than you expect once the system believes the tightness is durable. Now, here is the simplest checklist you can carry without turning your life into a full-time research job. Watch for the policy, follow-through, footprint, not rhetoric, footprint, moves that show the system is actually trying to build resilience. Watch for the processing bottleneck footprint, announcements in progress that show where refined and fabricated supply is coming from. Watch for the immediacy footprint, persistent premiums, longer lead times, and stubborn dislocations. If you see the first two without the third, the system is trying, but the market is not tight yet. If you see the third without the first two, the market is tight for other reasons, and policy is not the driver. If you see all three, you are watching a real regime shift. And here's where I give you the cleanest possible takeaway. Silver did not become rarer overnight, but the rules of attention changed overnight. And attention is capital. Capital is planning. Planning is procurement. Procurement is buffers. Buffers reduce free metal. Reduced free metal increases the price of and the price of immediacy is what makes silver feel like a different market. So do not stare at the daily candle and ask whether this list was bullish. Ask whether this list changes how institutions behave, because institutions do not need to flood the market with buying to matter. They only need to tighten the system as optionality enough that the next stress event bites harder than it used to. Now, if you have made it this far, you are not here for noise. You are here for mechanism. Subscribe, because this channel is going to keep doing this one supply chain at a time with calm and receipts and incentives. And share this with a friend who thinks commodities are only charts. The fastest way to get smarter is to stop treating supply chains like background scenery. I will leave you with one last image. A warehouse door. In a loose market, that door swings open, easily metal flows, premiums behave, the world feels normal. In a tight market, the door still opens, but it opens slowly, and only for the people with contracts, and only for the people willing to pay the rent of immediate. The critical designation is not the moment the door slams shut. It is the moment the system admits the door matters. And once the system admits the door matters, it starts building keys quietly, deliberately, and then one day, the market looks at the chart and wonders why silver feels different. It feels different because the world decided it could not afford to be surprised by it anymore.